Good morning and welcome. I'm Mohini Naidu, Investment Analyst at Ned Group Investments, and it is my pleasure today to welcome Stephen Romick of First Pacific Advisors. Steve is the co-portfolio manager of the Ned Group Investments Global Flexible Fund, and he will talk to us today about the recent performance that the fund has delivered, some of the drivers of that performance, and how the fund is positioned to be resilient to the continually shifting tectonic plates of the global economy, not just to survive the short-term volatility, but to thrive over the long term. Steve, welcome, and over to you.
Thank you, Mo. Thank you, Ned Group. The Ned Group Investments Global Flexible Fund has had the same objective for decades, which is to provide an equity-like rate of return over the long term with less risk than the market while avoiding permanent impairments of capital. Said another way, we look down to protect our investors' capital before we look up to maximize the return on that capital. Emphasizing capital preservation might cause us to miss some upside, but over time, it should smooth the ride by not getting knocked around as much in the downturns. We have delivered equity rates of return for our partners over time, largely by owning shares in companies domiciled in various countries around the world, but also by owning higher yielding corporate bonds and distressed debt, of which there has been little in the past decade. We've also run with a fair amount of cash that has muted the downside in down markets, while also serving as a source of funds of which we might avail when opportunities present themselves. Equity exposure was about 70% at quarter end and is just slightly less than that today. That exposure is a bit overstated as it includes 2.5% exposure to special purpose acquisition companies or SPACs, something which we've spoken about in the past. These so-called blank check companies offer us the optionality that would come along with an attractive acquisition with almost no risk of losing principal. Heads we win, tails we don't lose. We expect the returns from this basket to rival, if not exceed, that of high-yield bonds, but without the same downside risk. Adjusting for the SPACs, the net risk exposure today is closer to the mid-60s. Cash is a byproduct of our investment process, and we hope that, on average, in the coming years, opportunities present themselves, and it will lower, and then cash will be lower than the current 30% or so, and will average much less than it has in the past. Looking at sector allocation, you will find that the fund's exposure is tilted to those sectors that we believe offer tailwinds well into the future. That would include communication services, with exposure to two of the most significant U.S. cable companies, Charter and Comcast, as well as global information tech leaders like Alphabet and Meta. Despite recent outperformance, energy remains a sector to which we have no exposure. The fossil fuel-based companies, which are still some of the larger companies in the world, have on average been terrible asset allocators historically, although recent world events have allowed them to deliver excess returns of late. Since we aren't traders, our focus is on the long term, and we have a more extended time frame in mind, which makes it hard to see how the world, and we recognize how the world uses as much, we won't use as much oil in the future as it uses today. We prefer to own those businesses that offer better, longer-term growth opportunities. We believe that the portfolio today is comprised of more higher quality companies than any point in its almost 30-year history. The fund's geographic composition is currently 73% North America, but only 43% of the revenues come from North America, and that's an important point. We think that where a company has its headquarters isn't as remotely important as where its revenues are derived. So, for example, while only 6% of the fund's equity investments are based in Asia Pacific, almost 23% of our portfolio companies' revenues come from that region. The fund has outperformed its key benchmarks as the market has declined and has performed relatively in line with the performance indicator over longer time frames, despite running with far more cash, which inherently means should mean less risk. Now, while one can reasonably argue that since our security selection has been so good, had we been fully invested, the fund's outperformance would be significant. However, We remain stalwart in seeking to protect capital first and get a return on it second, even if that means lagging in bull markets. Quarterly performance carries with it a lot of noise. We therefore prefer to speak to drivers in the trailing 12 months, which is the bottom half of this chart. By and large, our companies performed within the range of our expected outcomes. There wasn't much by way of news that has driven the performance of our portfolio companies in the last year, other than Chinese regulators cracking down on alleged monopolistic behavior of their country's tech giants. While we have a generally favorable view of the fund's Chinese tech companies, as a function of business quality, growth opportunity, and price, in that there are no guarantees in this world, the fund's exposure to the sector is a very small 1.3%. The Net Group Global Flex portfolio has a look-through PE of just 15 times this year's projected earnings. That's a consensus-based estimate for this year's earnings, not our own. We hope that such an undemanding valuation for our portfolio companies, and less than that of the market as a whole, combined with these companies meeting our conservative assumptions for their growth, that should contribute to solid performance in the future. One closing thought. The tragedy in the Ukraine leaves us few words that haven't already been said. Ukraine and Russia, though, are relatively small parts of the global economy, with the Ukraine running less than 0.2% and Russia just around 3% of global GDP. However, Russia is the third largest oil producer, with around 12% of global oil production, and the second largest gas producer with around 17% of global gas production, and has the world's largest natural gas reserves at about 24% of the total. And Ukraine and Russia together produce nearly 30% of the world's traded wheat. The war's global economic impact has therefore had a disproportionate impact on food and energy prices, further stoking the inflation fire. All of this, however, bears far less relevance than the larger humanitarian crisis that continues to unfold with uncertainty. Our thoughts are with those families and for those people who have family and friends that live in the Ukraine. Thank you for taking the time. I'm going to turn it back to Ned Group for some Q&A.
Thanks very much, Steve, for that succinct but at the same time comprehensive update on the fund and the drivers of those performance. So, your concluding remarks are to follow on from that. As I'm sure you can imagine, investors are anxious about the unfolding geopolitical turmoil, and notwithstanding the remarkable rebound in performance post-COVID, this turmoil carries huge risks for a world economy that's yet to fully recover from the pandemic shock. Now, while Western governments are taking steps to curb Russian hostilities, some would argue that so far it's had little impact on restraining Russia's aggression and the human rights atrocities being inflicted on the Ukrainian people. They are, however, very much aware, no doubt, that by taking steps like financial sanctions, they're likely to heighten the impact of the conflict on their own economies. So how do you and the team navigate this landscape to position the fund to survive and thrive beyond these human and economic crises?
I mean, it's a good question, because there's uncertainty that comes with this environment, but there's never been an environment that hasn't come with uncertainty. This time, I mean, and every environment's a little bit different, although we try to look at analogs, historically. And we do believe in the triumph of the human spirit. We are optimistic that the world will be a better place, at least, from an investing perspective over the next 10 and 20 years, albeit with, volatility. We are in an environment where debt is high, both at the sovereign and personal level. Interest rates are high and going higher, but are still historically very, very, very low. Inflation is high, and that is pushing central banks to take further action on rates. Affordability for individuals is low, and this, if you put all this together, given where prices are for securities, it's not a home run environment setup, which is why we remain cautious, which explains the 30% or so in cash that we continue to hold in our portfolio. As every time you've seen this uncertainty kind of manifests itself in fear at various points in time, as we did most recently with COVID in the first quarter, you see us acting, to lean in when there's significant, downdrafts. Allows us to reposition the portfolio, allows us to pull down the cash and buy more of the companies that we already own and we like, or it creates opportunities in new companies. And hopefully at some point in time that will translate to distressed debt and high yield bonds, of which there's been, sadly little opportunity over the last decade. So I think the important point I want to leave you with is we have a portfolio that is conservatively postured with the highest quality companies we believe we've ever owned in the life of the fund, with a lot of cash on the sidelines to be able to put to work when the opportunities with attractive risk rewards, present themselves.
Thank you, Steve. So sticking to the tried and trusted process and philosophy that you have implemented over the last 3 decades now. Now, while you currently have no direct exposure to Russia in the portfolio, energy prices are the main channel through which the Ukraine war has an immediate impact far from the front lines. This risk is particularly acute in Europe because Russia is its main supplier of oil and gas. So perhaps you can share with us your views on how Europe in particular, where you do have a reasonable allocation to the portfolio, around 18% as at the end of March, is likely to endure an energy, supply chain and trade shock, and whether you and the team are reconsidering your thesis for investing in this region.
Well, I want to add to your question a little bit, because I think the food shock is not as broadly discussed as it should be. I mean, given that Ukraine and Russia is part of the global breadbasket, that feeds the world. And what's happening is we have more people that are undernourished. And so with roughly 800 million people that are undernourished today, we have another coming on as a result of this crisis, an estimate of 13 to 15 million people, being added, to that cohort. And with that, as people, fall into poverty, as people don't have enough food, that creates the foments unrest. And that's probably, the greatest concern. I'm less concerned with that in Europe than I am in other parts of the world, candidly. So as long as this conflict remains in its tidal region, doesn't spread, further, east and, further west and southwest, then we don't have any greater concerns longer term about Europe. Now, there's always some hiccups that come along as you have to manage through this. I mean, there's a tremendous, the largest economy in Europe, Germany, and they have a tremendous energy dependence on Russia. So there's going to take some time to wean themselves, but there will be a reset as there has always been over time. And so we are mindful of the kinds of companies we own and the valuations that we pay for them. And we have to be able to, be willing to own these quality businesses, through periods of uncertainty, because trying to time it is a functional impossibility. Let's just say one was to say, well, this is all too scary, let's go to cash. And by the time there's a settlement of the conflict, in the Ukraine, then those stocks have already rebounded dramatically, and you've just missed, a huge move. And so their volatility is part of investing and as distressing as it might be, for some, it is something that our portfolio is historically as a byproduct of the investment process, not as a top-down view that we want to lower volatility, but as a byproduct of what we do, we've tended to have a little bit of a smoother ride along the way. But our ride is not going to be, without some, hitting some potholes.
Mm. So as a follow-up to the previous question, are you and the team discussing the potential for a structural shift that may result in the deglobalization of the economy in response to these recent crises to reduce the Western dependency on offshore goods like energy, semiconductors, and offshore manufacturing, to name a few?
Yeah, we've chatted about it. We don't have a strong investment position to take as a result about it, but we are aware that there are certain I don't want to call it, I don't believe there will be a complete deglobalization. I think that's improbable. However, there are elements of bringing certain manufacturing back to your own country, and there's a couple reasons for that. One is that even prior to COVID, there was you have the advancements in robotics and AI, which allows those countries that have higher labor costs to be able to manufacture more cost efficiently today than they were 20 and 30 years ago, because you've taken labor out of the equation. So that makes it less relevant, less of a need to go and purchase, say in the U.S. from the Pacific Rim, particularly when you can save money on shipping and shorten your supply chain down by having something more local, which leads to the second point, which is a result of COVID. We realized that the supply chain was a little too extended. We needed to have more certain kinds of goods manufactured here, so we can have get them into stores more quickly, whether it be masks, K95 mask or whatever it might be, or semiconductor chips, et cetera. So there's a certain need to have certain necessary products manufactured here, as well as I said in the first point, which is having a tighter supply chain, which is a direct result of having a lower manufacturing costs in the U.S. And so we are mindful of that. We look at our different companies, who's the beneficiaries of this. And the U.S. economy actually could be and should be a beneficiary over time. This is not going to happen quickly. And if you look at the Pacific Rim, there'll be some manufacturing nations that are going to be a little bit more stymied by this, as some of that manufacturing leaves their own shores and comes across, back to the U.S. or whatever the other higher cost country is.
Steve, just one final question. Without wanting to minimize the very real human impact of this crisis, particularly in Ukraine, are there any reasons for you and the team to feel hopeful about the future for the next generation?
There's always reasons to feel hopeful. It's always hard in the thick of it to find that. But if you look over time, there's a lot of good things that are happening in the world in different countries, and I think that as long as people continue to pull together and operate with a favorable mindset as to making the world a better place, then I'm always hopeful. To not be hopeful would make it very, very hard to get up in the morning.
Agreed. So I'm glad you and the team are at least seeing, some lights at the end of this, what is for now a very, very dark tunnel. Steve, thank you very much for your time and for sharing those valuable insights with us.
Thank you.
Wars are inherently unpredictable, and the actual outcome is likely to be a lot messier than any of the potential scenarios that are considered. Wild swings in financial markets are an illustration of the fear and uncertainty that we are all experiencing. To sum up how FPA think about and look at the world as portfolio managers, I would like to read to you the following quote that they sent to me from the company chairman of Richemont in a speech he made back in 2013. What I do know is that our businesses have withstood really bad governments. We've withstood revolutions. We've withstood world wars, if you look at that over the centuries. And we will withstand, I don't know how to put it strongly enough, the bad governance that we've seen over the last 15 years and that we're seeing now. So we'll withstand it. And with that, a very special thank you to our investors from all around the world for dialing in today and your continued support. Stay safe and keep well.